Once again, the three-legged stool. You have Social Security, which everyone thinks is very risky, probably won't be around. That's what we keep hearing. My grandparents said that. My parents said that. I don't know if it's going to be here. We have to plan for ourselves. I think that's the bottom message here. Fewer companies are holding pensions. You know, very few companies right now have pensions. A lot of them are dropping them or reducing the benefits. So we've got to really talk about our personal savings. How much will you need? What's the shortfall? And how can cash value life insurance come into play here? That's, I think, what we're all thinking about and trying to wonder. How can cash value life insurance help us? How will taxes affect your planning? Because that's important. If you'll look behind me, this is a very, very important slide. Because if you can see over the years, you really don't know what the taxes are going to be. And here's the thought process. Probably back in, I would say, 1980 or so, we came out with the IRA, right? Where you put money back, you put it back, qualified money, you don't pay taxes on it, it grows tax deferred, right? Don't pay money on it, on the growth, no taxes. When you take it out, you pay taxes. The whole thought process is when you're making money now, and you're in a certain income bracket, you put away money and your income bracket goes down. That money grows tax deferred, and then when you retire, you're making less money, you're in a lesser tax bracket, you pull the money out then and you actually pay less in taxes. That's the whole thought process. Unfortunately, guess what? That was back when we had a lot of different tax brackets. We had the highest marginal tax bracket at one time was way over 78, 80%. Well, you know what? If you're deferring taxes now at a lower tax rate, and then where do you think taxes are going to go in the future? Up or down? More likely. When we don't have that crystal ball, we talked about that a second ago. But more, what if you defer taxes now, and then taxes go up and you pull the money out of a tax qualified plan, you're ending up deferring taxes at a lower tax bracket and paying them at a higher tax bracket. That's totally opposite of what we originally designed this particular type of qualified plan. And you're going, okay, David, why are you telling me about this? You're the life insurance guy. Where does life insurance come in with this? And I'm going to explain that to you now. And once again, the perfect tax retirement plan is contributions that are tax deductible, they're deferred, and you take them out, they're taxable. I described one a few minutes ago that it's after-tax money, it grows tax-free, and it comes out non-taxable. These are the plans that come with this particular concept. You have your traditional IRA, your 401k. Then over on this side, you have a Roth. Some of us may be in a higher income bracket where we can't take advantage of a Roth IRA. Municipal bonds, and then cash value life insurance. Obviously, I'm going to focus a little bit of time on the cash value life insurance. It's a protecting your family with whole life. It can be paid with after-tax dollars. Once again, the tax deferral. You can enjoy some of the money on a tax-free. Remember a few minutes ago I said, how much money do you want non-reportable income at retirement? You remember that? You said a lot. Well, I'm going to show you how you can do that. Right now, if you have a 401k, you want $100,000 at retirement every year to come out of your 401k. You take $100,000 out, 100% of it's taxable because it was put back with pre-tax dollars. And if you're in a 25% tax bracket, you're paying $25,000 tax. Basically what you have is $75,000 after taxes to spend. So you're pulling out 100, enjoying 75,000. That's the traditional way. But if you would take your pre-tax dollars and only pull 50,000 out, 100% of it's taxable, but because you've gone from 100,000 to 50,000, now you're down in a lower tax bracket at 15%, you're going to pay less taxes on the 50, but then if you have a nice cash value life insurance, a whole life, a universal life. In a minute I'm going to talk a little bit more about some term insurance and the different types of insurance, but if you take your cash value life insurance and diversify This is a diversification. You can pull money out of your cash value life insurance. It's not taxed. And I think the biggest point is that circle right there. Because before you got out of 100,000, you got 75. You're pulling 100,000 out. You've got more spendable dollars. That's what we want to do. You want to get the most spendable dollars at retirement. You're paying less tax. So now we don't have to worry about that crystal ball and what's going to happen in 15 and 20 years down the road, because we don't know. Now you're actually diversifying your tax plan at retirement, which is a very clever concept to do. Now, a lot of you in the room, and I know the community very well, a lot of you in the room, you'll buy life insurance, cash value life insurance, and you will never touch it. The cash is there. I know that. But you know what? To have that option back in 2008, when the market went down and things got tight, if you need money, you can get it from the cash value life insurance plan. You may never need it, but it's nice to know it's there if you need it. Wouldn't you agree? Yes. Nice to know it's there. So this is the major conversation that I wanted to share with you tonight, this afternoon. And I got a few other slides to go through. But really focus and start thinking, where are you in your progress with retirement? Are you going to take all your income from a qualified plan? Are you going to sell your business if you can get a buyer? May not. How are you going to have money, and how are taxes going to affect you at age 65, at 68, at 70? So this is just a good concept to think, all right, I want to diversify, and I want to balance out my retirement plan. Make sense? All right? This is something that a lot of you will like. If I asked you, what in your portfolio has guaranteed death benefit? In other words, if something would happen to one of us, New York Life would step in and give your heirs money. What in your portfolio has premium never to increase? Once you lock in a premium, it doesn't go up. How many of you bought a car 20 years ago? Raise your hands. There's only one of you bought a car 20 years ago? My son wants a car today. He's not going to give it. Right? So were the cars cheaper 20 years ago than they are today? Of course. Everything was cheaper then, right? So what I'm telling you is, if you buy cash value life insurance, you're locking in a premium that you will never have to worry in 20 years. It's not going to go up. It's got a guaranteed premium. Guaranteed cash value growth. That G word, for the longest time in the financial industry, we could not talk about guarantees. But with whole life insurance, you can talk about the guarantees, because every year you have a guaranteed cash value growth. Additional growth through dividends. New York Life is a mutual company. We are not owned by Wall Street. We do not sell stocks. We are a mutual company. Very important. When you do business with someone, do business with a mutual company. There are several nice companies out there. New York Life is one of the top-rated companies in the entire industry. You want to make sure that you do business with a mutual company, because we don't answer to Wall Street. We don't have to worry about quarter-over-quarter returns. Who owns New York Life? Our policyholders. Tax-deferred cash value growth, protected from creditors. How many of you own your own business? How many of you own your own business? Let's see. Y'all don't like raising hands today, do you? Right? All right. If you own your own business and something would go wrong, people can try to get and come in and put a lawsuit against you. They can try to get your assets. Life insurance is protected from creditors. It's protected from those situations. Very important. A lot of very wealthy people put money into cash value life insurance for that main reason, to protect it from creditors. Access to your cash value through tax-free access. That's the part that I talked to you about of non-reportable income at retirement, and an income tax-free death benefit. In other words, I need you to understand, I think a lot of you do, that in the event of one of us dying, the life insurance proceeds that go to your beneficiaries are 100% tax-free. So if you got money in an annuity, money into a mutual fund, and you die and that money goes to your family, there are possible some tax issues there. But life insurance, unless it's some certain situations where it may be a modified endowment, which very seldom it is, it goes 100% tax-free. Not one dime is paid in taxes. Very important. If I were to ask you, what in your portfolio, what in your investment strategies that you're doing right now has all these benefits? I don't know of anything that has all those benefits except whole life insurance. All of those. Here's something pretty interesting. If you are in the investment world, Ibbotson is a name that you're probably familiar with. Ibbotson is a huge company. They're very respected in the financial services world. And here's what Ibbotson says. Ibbotson says if you've got a portfolio, and forget the blue part right here, right now, but if you've got a portfolio that's 60% equities, 40% fixed income, what we're suggesting that you do is you take half of your fixed income side of your portfolio and then put it into cash value life insurance. And they are saying the reason why is because a mutual company like New York Life has 168 billion, that's a B, billion, in assets. That's pretty good size. We are diversified so well. Our largest holding is AT&T at 240 million. And that's less than 0.2% of our portfolio. If AT&T went under, wouldn't affect New York Life at all. We have $240 million. But we are diversified so well that when you buy a cash value life insurance policy, you're buying into our portfolio. So what Ibbotson says is by taking some of your fixed income portfolio and putting it into cash value life insurance, you're going to increase your return and reduce your standard deviation. Your standard deviation is your total risk of your portfolio. Up until about 4 or 5 years ago in the financial industry, they wouldn't allow cash value life insurance to be talked about as an actual asset or a part of your investment strategies. But because of the downfall in the market in 2007, they saw that the mutual fund companies were so strong. We never took TARP. Y'all heard about all that stuff, the government giving companies money to survive. We didn't take any of those, didn't need it. Here's who has cash value life insurance. High net worth individuals and banks. If you go and you own your own business, and I know in this community you may not a whole lot, but if you ever need to go to a bank and get a loan, the first thing in the bank is cash on hand, and then number 2 is cash value life insurance. I know in the downturn of the market in 2008, a lot of people came to New York Life and they took money out of their life insurance policies, used it in their business, and when things started doing better, they put it right back in there. It was like it never happened. See, those are those options that I was telling you about earlier. Those are the options that you want to have. If you never use it, that's great. But you may want to. Banks own 82% of the largest top banks. Look at here. They own, why do banks own life insurance? That's where the money is. The banks buy big life insurance policies on their executives because they know the money's there and it's safe. If the banks are putting their money in cash value life insurance, maybe we should follow suit. Once again, I already touched on this just a little bit about New York Life. We've been around since 1845. We're a mutual company. We're highly rated across the board. As you can see, we have the highest possible ratings that anybody can give any insurance company. And that is what you need to look at when you start to looking at your life insurance. Who am I going to put it with? You don't want to put it with Ketchum and Cheatham Life Insurance, and I don't know who that is. You can make whoever it is up. But you want to make sure it's going to be there when you need it. And that's the most important thing. Once again, you've got term insurance. Term insurance is what I call temporary term. It's not there for you to have at age 60, 70. You can't afford it. It's too expensive. Term means for a certain period of time. Sometimes business owners will buy a very nice cash value life insurance policy, and then they'll buy a block of term. The term is just there for 20 years while they're in business in case something would happen. It's only for a certain period of time. The other part is whole life insurance. New York Life offers this traditional whole life insurance. Premiums due all the way to age 100. Or the custom whole life, where a lot of our clients came to us about 8 years ago and said, you know what, New York Life, we like cash value life insurance, but we don't want to pay premiums forever. So we developed and patented a product called Custom Whole Life. You say, David, I want to pay premium for 20 years and I don't want to pay again. New York Life says, we'll design a policy for you. You pay 20 years. It's guaranteed paid up. When New York Life says guaranteed paid up, it's backed by the financial strength of the company. Very interesting product. We also have a universal life product that is a interest rate sensitive product. It works a lot like, it's a cash value permanent product. Premiums don't go up, but it allows you to have the upside potential of the interest rates. Right now interest rates are low, right? Where do you think interest rates are going to possibly go in the future? So in universal life you have that upside potential. The last product I want to mention to you is a variable universal life. We call it VUL. It is similar to the universal life, except your upside potential, the extra cash that's in it, is invested into mutual funds. A lot of upside potential on that. There's a product out there now New York Life does not participate in, and I do want to mention it to you. It's an index universal life. If someone comes to you and wants to provide to you an index universal life, be careful. Just going to tell you, be careful. They promise you big upside returns with no downside. If that was true, we'd all run that direction. It's not true with the index universal life. They cap you on the growth, and they got a small base floor that you won't lose money on it. But if you're going to get into the market, take full potential of the upside.